Good afternoon to everyone. Welcome to today's webinar. It's exactly 15 hours and we'll be starting in a few minutes just so that a few more people can join us. Today's webinar was arranged by the University of Zambia Business and Economics Association Projects Committee. We are super excited to have you guys here. So please feel free to use the chat option. You can tell us what you're expecting. And if you already have questions in advance for this webinar, you can type them in the chat section. Okay, without taking up much time, we will start right about now. Today's webinar is based on financial risks and non-financial risks. And you've obviously been seeing the ad that has been going all around social media. Our guest for today is Mutisungile Zulu. I'm your host. My name is Nelly Mambwe and co-hosting with me is Elinase Hara. So we hope we are certain you will enjoy this webinar. If you have any questions, any expectations, please feel free to use the chat. You can type your questions in the chat or your expectations for this particular webinar just to let us know that you are with us and you are listening. So at this point, I'm going to introduce Mutisungile Zulu. He is the Stanbic Zambia Non-Financial Risk Head, and he is the Economics Association of Zambia National Secretary. He's going to present a webinar based on financial risks and non-financial risks. So please pay attention.
Thanks, everyone, and good afternoon. And thanks, Nelly, for that introduction, and thanks for beaming up for me. So my name is Mutisungile Zulu. So I work for Stanbic Bank. I'm a non-financial risk head, and at the same time, I think you know me as the National Secretary for the Economics Association of Zambia. So we're going to have a discussion, and it'll be an interactive discussion. So I'll be telling a story about the evolution of risk, from financial to non-financial. So I guess the first question is, we live in a world that's fast evolving. There's so many things that, affect business operations. They affect us, they affect our health, they affect the way we do things. And some things we do know about them, but we probably just didn't know how to define, to call them, or, one of those things. So I think the first point of call is, what is risk? Risk, from a statistical point of view, can be, skewed to uncertainty. So there are risks that say probability that, something will go bad. What is the probability that it will rain when you're building your house, and just after you've plastered it, and then the walls will just fall off, So all those are types of risk. Risk is you leaving your phone unattended to, without a password, and you use your phone to transact or to buy things on the internet. It means that somebody can actually get your phone and use it to purchase what they want. That is risk. Risk is leaving your door open, and thieves enter and, get your assets. That is all risk. Nelly, I don't know how you're doing with the slide, but I would like my presentation probably to resonate with the slides that I prepared. So I'll start, and then probably you catch up with me. So now that we have an understanding of what risk is, so the question is, I'm speaking to students of economics, of actuarial science, and other business-related fields, and I'll bring it down to your context. When you study economics, I guess there are things that you are taught in class. Things like, your factors of production: land, labor, capital, and entrepreneurship. These are things that you guys are very much close to. So we talk about land. You all know what land is, and the return there is rent. Labor, we all want to apply for a job when we finish school, and and then be given wages. Thank you very much. So we'll start by looking at your Cobb-Douglas function, which is a productivity equation. So you believe that if we can mix land, labor, capital, and entrepreneurship, and another factor of production that is never really spoken about at length, technology, then would be able to effect growth. This is the equation that drives the world. This is the equation that drives Zambia. So on land, I've spoken about minerals, agric, labor is the most important factor of production. You will appreciate when we move to the next slide why I've started with this. So I wanted to break it down and bring it to things that you are taught in class, but then will be more granular and applied to the modern world. We talk about capital. When you hear people talking about the cost of capital is high, people can't get loans because banks always ask for collateral. That's the same factor of production. We talk about entrepreneurship, which is now human capital, your brains, your ideas. Some of you want to start businesses. Maybe some of you are already doing businesses. Ideation, you have ideas. And then technology as an enabler. We're using a technology platform right now, as you can see. So we can move. So we'll come back to this productivity equation. So what is risk? You have two very interesting pictures there. Risk is a wildcat. When you're in the bush, a wildcat can bounce on you anytime. The bush is a very risky area. And that's how I want you to view risk. That thing that you know will happen, but you just don't know when it will, because once it strikes, you're gone. But you need to prepare for it. That is risk. Risk is you being aware of someone out there, someone in Russia. You don't need to get on a plane to go to Russia. Someone in Russia can actually hack into your phone, and someone in Russia can actually, ransomware your assets and demand you to pay or else they'll release your information. I think coming close to home, we've seen some of those things that happen on social media where you have an illicit video and people are using that to blackmail you. That's cybercrime. That is all risk. So digital transformation, I talk about digital transformation because all of us can relate to it. Everybody has a phone. So some of you that are using your phones are actually streaming to listen to this webinar. You're using your phones, you're using your iPads, you're using your laptops, your MacBooks, but digital transformation has changed the way things are being done. You're sending emails to communicate. You don't use telegrams anymore. You don't write letters. If you need to speak to your parents, you pick up a gadget, you talk to them. The way we are making transactions, the way you're paying for your fees, your registration is being done online. All that is digital transformation. If you look at the way banks are transacting now, I don't need to go into the branch. I can actually do everything from the comfort of my phone. That is digital transformation. But digital transformation comes with its own evils. Why? Because there's always somebody who is 10 steps ahead of what anyone that is thinking of digital transformation is actually doing. So you've got cybercrime. It's one of the biggest risks, if not the biggest. It's very much downplayed. Just 3 weeks ago, we are told that there was an operational glitch at the US Fed. That's the biggest central bank you have in the world, where they were not able to to process transactions. It could have been cyber related. Somebody could have hacked into the system. People are even saying potentially the next financial crisis could actually be cyber related. People are not into using guns anymore. You've heard of allegations in the US where Russia has been accused of hacking into the US electoral system just to skew whoever has won, So all that is cybercrime. So cybercrime can also be as simple as not what you think when you watch those sci-fi movies and somebody's trying to crack a code and running an algorithm that will give them potentially 1 million passwords. Cybercrime can be as simple as you sharing your card with your friend, with your girlfriend, with your parents. They share a PIN with you. It means that PIN is supposed to be for you. But if you give it to someone else, it means you're giving them access. They can get that. That's cybercrime. We talk about card fraud, mobile money transactions. People can actually hack into your system. There's SIM swap. Somebody can replicate your SIM and start transacting, and your SIM, that number would definitely be connected to your account and they'll still be able to move funds, and you'll be surprised thinking, and you see, it's actually very interesting because these are some of the things that banks have been accused of, to say, you're stealing my money. But guess what? You actually stole your own money because you were careless with your PIN. So all that is cybercrime. And that's why you find all those cameras at an ATM, because if you come and make noise and say you're missing money in your account, we'll just ask you to say, when did this money leave the account? It will show the time. Security will just play back that ATM card and the video, and we'll be able to see whoever was transacting on your account. And sadly, it could be someone that you gave your PIN to. So sharing PINs, very dangerous. Those of us who make online payments, have you noticed that when you get your phone and then you load in your card number and your PIN, and it asks you to say, do you want this phone to remember your PIN every time you transact? And then one of these days you forget to lock your phone, and whoever has access to your phone will still be able to transact. So I won't spend so much time on that, but I just want you to understand that digital transformation is something that is actually related to economics. This is called the economics of digital transformation. So if you thought economics was just about land, labor, capital, and entrepreneurship, well, the world has actually transformed, because now we are getting granular into those factors of production, those enablers, those drivers of growth, to help us understand what we can do and what our role is. And to digress a little bit, if we don't wake up and be alive to most of these risks that we're dealing with, you will find that data scientists will replace you as economists, because now a data scientist is a person, that is more clued up when it comes to data. I mean, how do you make decisions in the absence of data? Economics needs data. So all that becomes very important. So we can move. So then let's start with the globe. We actually live in a global environment. If you actually asked me and told me what's actually driving the world, this slide says it all. That's exactly what is driving the world. How? These are global risks. I haven't ranked them in order of severity because they keep fluctuating, but the first one actually speaks to climate change. Remember, this is a discussion around financial and non-financial risks. Financial risks are risks that you can quantify and lead to specific loss. For example, if I do a transaction and my exchange rate moves in one way and I lose money, that's financial because it's got a financial impact. But now you have silent risks called non-financial. So something will happen today. You might think that you didn't lose anything, but guess what? Your reputation could have been lost, and in the future, people stop doing business with you. So the risks, the financial aspect only tends to be quantified at a later stage, but you would have been exposed. And that's what the evolution is all about. So we're talking about climate change. What is climate change? You and I are able to relate to what the world has become. Deforestation. We're not planting trees. Because we are building shopping malls everywhere, we are degrading land. We are felling trees. That is why you find that there are pressure groups. You know what they do? For every tree that you cut, you replace it with 2 other trees. I know a guy, he runs a company that makes pencils for primary school pupils. You know what they do? In that pencil, there are seeds. When the pencil finishes, you have to shrimp it in the ground because you know what you're doing? You're actually planting a tree. So for every pencil that you buy, there are 2 seeds in that pencil. And these are guys that are trying to champion climate change. So because of cutting down trees for various purposes, because we want to develop, we have deviated from nature. And deviation from nature has caused, this photosynthesis and these other biological processes that happen in the environment to be tampered with. And as a result, rainfall patterns have changed. How relevant is it to economics? So because your rainfall patterns have changed, that's why you have power rationing, your blackouts, your load shedding. What you're calling load shedding is because it didn't rain that much. And because it didn't rain that much, you didn't have enough water in the Kariba, and energy generation is now at risk. So you can actually see that a simple action such as me thinking about going to cut down trees so that I can sell charcoal for people to cook or to keep warm in the villages, but without thinking about replacing those trees, is actually then manifesting in a very grave problem, which is energy deficits. And that's why we've been having load shedding. That's why our rainfall patterns have shifted. That is all risk. That is climate change. So we're saying from a climate change perspective, the food we eat is related to climate change. Have we failed land? Have we cut down trees so that we can grow food, but without thinking about how exactly we will replace those trees? And that is actually manifesting in climate change risks. And that's a global risk, and that's top risk number 1. Even before we had COVID, the world was grappling with climate change. The second one is disease pandemic. Pandemic risk, nothing very strange. We all know what this has done. There's a very fancy picture of a vaccine there. I don't know if it's AstraZeneca, BioNTech, Pfizer, or Johnson & Johnson, whatever the case, but you have seen what pandemic risk can do. On this one, I'll take you back to the factor of production, labor. You've seen that human beings are very important. It is labor that conducts entrepreneurship. It is labor that is the factor of production that mixes all these other factors of production, because without labor, then these other factors of production can be crippled. But look at what pandemic risks have done. Crippled economies. Because of COVID, supply chain disruptions. People have lost jobs. People have died. Look at what has become of the world. Growth in the negatives for 2020. The world was on its knees. But you can imagine that because of COVID, there were supply chain disruptions to the extent that it affected the commodity markets. It affected the stock markets. You can actually see that pandemic risks did price into financial markets, which you brag about when you're doing your economics. You talk about interest rates, exchange rates, but did you ever know that a virus could indirectly impact your markets? Did you know that a virus could cause people to behave in a pattern where they are more comfortable, locking up their liquidity in dollars because they feel that the dollar is a safe haven. Today, if I asked you, would you want to keep your money in dollar or kwacha? You tell me you want to keep your money in dollars. Why? Because a unit of dollar will give you more kwacha going forward. But what is causing that behavior? The effects that pandemic risks have caused. So you want to be safe. Your investments are at risk. Those two eggs, the US and the Iranian flag, that's geopolitical tension. That's another risk, geopolitical risk. Do you know that every time there are threats in the Middle East between Iran, Saudi, and the US, the price of crude fluctuates? You know why? Because markets are pricing in a potential war and saying, if these guys go to war, it will disrupt the production of oil. And you know what will do? That will cause shortages. And what does a shortage do? You are more clued up in economics. It will push the price up. Why should a guy like me in Zambia worry about oil prices going up? Then it means that my fuel prices will go up. So what if my fuel prices go up? It means that manufacturing costs will go up and manufacturers will pass on those those increased prices in higher selling prices. And that's what you call inflation. Not just that concept of too many goods, too much money chasing few goods. Yes, it does matter, but then you've got the cost push aspect and you've also got the demand pull. Inflation comes in various points. Even importing goods causes inflation. So that's just to show you that geopolitical tension is it's one of the top two risks. And that's why the relationship between the US and Iran over nuclear weapons is a very delicate one, because once they start threatening each other, now with the US election, we've got a new president. So the question is, how will he relate with Iran compared to how a Donald Trump reacted, and how we are actually seeing oil prices moving up right now? Why is it that when a vaccine is stopped, when corona cases start going up, then crude prices start going down? It's because the world is pricing in economic growth. So the more vaccines are being rolled out, the less the COVID cases, the more hope there is for the world to claw back its lost growth and greater economic growth prospects. And because of that, there is forward-looking views where the markets are then pricing in potentially increase in demand. And that is actually causing your crude prices to go up. So these three things I've spoken about, trust me, are what are driving the commodity markets. And you need to know about these as students of economics, data science, or actuarial science, or even risk management, because therein lies the risk. That is where decisions to hedge positions come from. Two other pictures there. You've got Joe Biden with Xi Jinping. Why have I put it there? Another risk that is driving the world. With Donald Trump having rattled China, the US-China trade war, another big risk. You remember, on one day you wake up, the two are getting to an agreement. In the evening, one rattles the other. The decision has been cancelled. That's uncertainty. That is risk. So all that, you will see it pricing into the markets. If you follow stock markets, you see the Dow Jones moving in a different direction, S&P 500, NASDAQ, and all that for liquid market. That is what risk is. And lastly, I'm going to talk about Brexit. You can see a Boris Johnson there smiling with his counterpart, who's now the leader of the European Union. You saw how Brexit kept people on their seats. We were on the edge. One moment, a Brexit deal, next, no deal. But look at what Brexit has done. It has caused, it's the biggest shift in trade policy. Because it's the biggest shift in trade policy, what it means is that if there are African countries that were trading with the European Union, and now that Britain, which is a big trading partner, has left the European Union, you know what that means? It actually means that maybe there won't be enough demand for the exports coming from countries like Kenya would be, flying fresh cut flowers worth 5 billion every year into the European Union. At some point, our own Zambia Sugar used to export sugar to the European Union, and our sugar would actually find itself in Britain. But now with Brexit, it just cuts all those relationships, and it becomes very difficult because trade is uncertain. So right now, Britain is actually looking for trade partners, and that's why they're on rampage. They've been talking to the US, they've been talking to a number of parties. They will come to Africa. They've been talking to Kenya directly because they're looking for markets. So just that move in itself has distorted trade. So I want you to look at risk on a global scale. Everything that I've given you packaged is what is driving the global economy. The US-China trade wars is what is driving the base metal market in terms of copper. When the Chinese economy is not doing fine, demand for copper comes down. China buys 40% of the world's copper. So if China was in lockdown, it means that all that copper that was coming from Africa, from the DRC, from Zambia, could not get to China. What does that do to our mines here? They're not making any money. Stockpiling. So that is what supply chain disruption. Supply chain disruption caused by COVID is as simple as the Lusaka International Airport could not be commissioned this year. Guess what? Because engineers that were supposed to come in with radar equipment from China could not travel because of travel bans, lockdowns. So you can see how just a small virus that apparently there's a joke that the viruses that are in the world put together can actually fit in a Coca-Cola can. That's possible because the virus is very, very tiny. But imagine something that can fit in a Coca-Cola can. Look at how it has disrupted the entire world. We can move to the next slide, Nelly. Thanks for that. I just wanted to emphasize on this point. So then I'm gonna bring it back home because I think it gets more exciting when you start talking about things that we can relate to. Energy risks. What are energy risks? When I talk about energy, I'm not only restricted to power generation, I'm also talking about fluctuations in crude prices leading to potential hikes in fuel prices. And I'm actually showing you inflation there and saying your inflation is actually ballooning. It's at 22.2%. And then you've got GDP growth. Last year growth was minus 2.9%. This economy shrunk, but that shouldn't scare everyone because I think that was systemic across Africa and across the world. The economies did shrink. So I'm talking about energy risks. What are we sitting on right now? So do you know that load management is a cost for a business? So if you're going to shut down power for 12 hours, 6 hours to 12 hours, I know that load management is still happening right now. If you're going to shut down power, then it means that you're going to disrupt production. And if you disrupt production, then there will be no goods to sell. So what solution have manufacturing companies come up with? They decided to buy gensets. But then if you buy a genset, it means that you can't run a genset with water. You need to buy diesel. But the question is your fuel costs are high. So because of that, you can actually see that energy in itself is actually another driver of inflation. Because if a manufacturer is going to complain about high fuel costs, they're burning so much diesel because their gensets are running for 12 hours. If the mines are buying diesel, and let me deviate a little bit. A lot of you don't understand how mines work. A mine does not work like the way you switch on your radio in your room when you're listening to the news, and when you're not listening to it, you switch it off. No. Once you switch on that equipment at the mines, you don't switch it off. It will actually take you 1 month to get it running to a point. These cement manufacturing companies, for you to switch on a kiln where you bake limestone to make cement, once you switch it on, it's a fixed cost. There is no switching it off. You see why it's very painful when companies have workers that are going on strike. When you hear there's a strike in the mines, when you hear there's a strike at a cement manufacturing company, then it means that you're not generating money to be able to meet your fixed costs. So whether or not you're making money, you have to find money to pay those costs. So energy, let's come back to energy. So what are the drivers of energy? We've talked about load management, and I'm sure you can get an appreciation of how we can connect that to climate change effects. That is why you and me must be thinking about going green. When you hear people talking about going green, they're saying, let us find ways of being sustainable. How can we be sustainable? We need to think about cleaner sources of energy instead of us using coal-fired plants that pollute the environment. Why don't we use solar energy? Why can't we use geothermal energy? We're thinking about cleaner sources, and that's where people are going now. People that are building houses now, they don't worry about connecting their houses to a ZESCO pole because one, electricity is expensive. So people are thinking of cleaner solutions, renewable sources of energy. So if a person can use, the outlay costs may be high, but people are going green. Look at Stanchart. Their building is green. So it means that all the lighting inside and whatnot is coming from the sun. You have cells that charge your batteries. So you reduce on your operation costs. Agriculture is becoming smart. People are going smart agric way. Instead of you using ZESCO power to switch on those center pivots to be able to irrigate, why don't you just use solar? Because God has given us the sun and it's for free. So there are some things that need to happen in the energy sector for these energy risks to be alleviated. There's a cost of service study, which is supposed to be cleared. Energy pricing is not optimal in Zambia, and all those things speak to energy risks. Simple things like a judgment in court can actually change what the energy outlook is. Just 2 weeks ago, SI 57 was U-turned by a judgment in court. The High Court ruled and said the minister's ruling was now void. And because of this, it changes how businesses like CEC will operate, because CEC was almost cut off. But what I'm trying to drive to is look at how a court judgment can change the risk landscape in favor of a business. It could also go against a business. That's why we're calling it risk. We never talk about risk of profits. We always talk about risk of losses. No one's interested in risk of profits. But just remember that for every risk that you take, you are compensated. And that's why they say the higher the risk, the higher the return. But in small font, they also say the higher the falls, especially if you're buying stocks. So crude prices, we've talked about it. So if the price of crude starts to push upwards, then you should expect that fuel prices will also go up. We can move to the next slide, Nelly. So the next slide, I want to bring it back home. And I would challenge you guys to get conversant with some of these indices, the indexes, I don't know if it's indices or indexes, that's indexes, that are used by the world, because Zambia is not exempt. It's called your Purchasing Managers Index. Google it, you will find it on Market Economics website. What is a Purchasing Managers Index? It is an index that gives you a business pulse month on month. Because I can't calculate what your GDP growth rate is month on month, you can use other indexes that will proxy growth. It will give you an idea of whether a business is doing fine, a sector is doing fine or not. So then, what type of risk does this measure? It measures a business risk. What is a business risk? I'm not here for definitions. I'm here to give you practical experience. Business risks, I'm going to look at aggregate demand. What happens when demand of my products is low? I'm not going to make enough revenue. But what are the drivers of demand? Maybe COVID. Maybe because of COVID, people have started buying more data because they are working home, just like Muti is doing this webinar from home. He's using data. You guys are using data. So that's aggregate demand. So you can actually see that it's twofold. On one end, people are using more data than buying actual credit, aggregate demand. Employment numbers, the index will show you whether employment is ticking upwards or it's ticking downwards. All these are factors that we need to know. We need to get granular about them. Supply chains, it's talking to me about lead times. So when I order something, when I order inputs, when I order raw materials from China, how long does it take for me to get them? Because of COVID, maybe I used to wait 3 weeks. Because of COVID, maybe I have to wait 7 weeks. So you can see that it's now shaping the way I'm thinking about my reorder levels. So if I'm somebody who's got a warehouse, I should start thinking about my reorder levels. What is my optimal amount of inventory that I can keep? And it's now speaking to my efficiencies in stock management. I need to know such that I don't get to run out. I need to know so that if I promise people and say, I will have this product ready on such a date, do I have the raw materials? I don't want to have that mismatch. All these things are things we should worry about. Just to give you an indication, Zambia has been in the doldrums for 23 straight months. We've been recording below 50. So the way this PMI works is that readings that are above 50 show that you are in expansionary zone, while those that are below 50 shows that you're in contraction zone. We've had persistent themes that have been weighing our private sector pulse. One, energy issues. So because of energy issues, business manufacturing costs have gone up. Secondly, the exchange rate has been the biggest headache. In fact, that is the biggest risk in Zambia, the exchange rate. Why? Because most of these companies have to get their inputs from outside Zambia. But for you to get your inputs from outside Zambia, you don't need stones, but you need dollars. This market doesn't have dollars. The scarcity of dollars is what is causing your exchange rate to depreciate. And that is why today you are 22.2. Why? Because the demand for dollars is way above the supply. We don't have enough supply sources. We are not manufacturing enough in Zambia. Let me deviate a little bit. When you go to the airport, you will see DHL have finally bought themselves a 737. It's a big aircraft. It's an awesome piece. I love the sound. It makes enough noise and yeah. But you know what? There's one thing about it. I'm told when it flies into Zambia, it's full. But when it goes back empty. It's full because you and I are buying modern clothes. We are buying iPhones. We are swiping and we are contributing to dollar demand. And yeah, I don't blame us because there's nothing for us to buy in Zambia. We can't buy locally manufactured phones. But when going back, it's very sad because it just goes away with two pilots. No goods coming from Zambia going to the outside. That is what your trade balance is. I'm talking to you about your trade balance because therein lie the opportunities to grow this economy. So instead of making noise about saying we want the currency to come down, why don't we start to influence decisions that will lead to increased manufacturing capability that will also speak to our ability to earn more in foreign exchange? Would you worry about the exchange rate if you're going to buy a car and it was in Zambia and it was being priced in Kwacha? No, you wouldn't. You worry about the exchange rate because the car that you want to drive is coming from South Africa, is coming from Japan, and you need to buy dollars. We can move to the next slide. I thought I should just emphasize on the PMI. So then let's talk about exchange rate risk. Everybody knows that last year, beginning January, the exchange rate was about 14 or is it 11? And then we closed the year at right about 21 and we're at 22.2. So what I want to speak about is that some of the risks that we have spoken to are now beginning to manifest in exchange rate risk. So what are the drivers of exchange rate risk in Zambia? One, petroleum demand. This one has always been there. Why? We don't have oil in Zambia. Well, we do have, but we don't have significant oil to be able to, service the entire industry. So we have to pay for oil in dollars. That one I understand. But there's also agri demand. You've ever heard of the Farmer Input Support Program? Yes, you have. It buys fertilizer, it buys seeds, and then gives it to small-scale farmers, which is a very good thing because we are hedging against another risk that we'll talk about, food security. No one wants to be hungry, so a hungry nation is an angry nation. So we talk about, so it helps us push up the bumper harvest. There's just one component I want to talk about, and that component is that we are importing that fertilizer when we should be manufacturing that fertilizer in Zambia. When inflation statistics are released every month, do take keen interest to read the ZamStats report and see what is driving imports. The one I checked for last month, it was ammonium nitrate. You want to guess what ammonium nitrate is used for? Manufacture of explosives. So that ammonium nitrate comes from South Africa and it goes straight to the mines. But imagine how we can remove that pressure on agri inputs if we recapitalized a nitrogen chemicals of Zambia, or if a private entity came up and started to manufacture fertilizer, then there'll be no imports. So what I'm trying to drive to is imports are killing us. And that's what your currency is trying to tell you. Weak reserves. Our reserves have dwindled. Why do I talk about reserves? Your reserve is the buffer that you're supposed to be using to cushion some of this pressure. So if we had enough reserves, we would be selling dollars on the open markets to cushion the pressure. That is not happening fully. You know what? The risk is that we risk depleting our buffer of reserves. How then can we build reserves? In those years when copper was trading for $10,000 a metric ton, we should have been keeping excess dollars in a sovereign fund. It's like saving money for a rainy day. You see why the concept of saving is very important. If you can't save, when that rainy day comes, you're going to be soaked. And that's exactly what is happening. Debt service needs. So because we have to service debt, and this debt that we have is in dollars, we are now competing for dollars with the private sector. The private sector wants dollars. And guess what? The public sector also wants the same dollars. Private sector demand. Let me correct one misnomer, and I'll please, if you want, feel free to quote me. Stop proxying GDP growth with exchange rate fluctuations. What am I saying? Stop concluding that when your currency is depreciating, then the economy is shrinking. That is very wrong if an economy is a net importer. I've noticed that people get excited when there's an appreciation. Appreciation in the currency does not correlate with growth. Two different factors. Do not mistake the two. In Zambia, sometimes when you have currency depreciation, it means that the private sector is trying to grow. When your private sector grows because they get their inputs from outside the country, it means that your dollar demand will start to shoot upwards. Because your demand is shooting upwards, your currency will depreciate. What happens when demand goes up? Prices start to rise. And what you see there when your exchange rate is depreciating. So sometimes I feel that we forget that we are a net importer and we start comparing ourselves to countries that are well balanced in terms of manufacturing. Like if we see something happening in the US, we also start wanting to correlate Zambia with the US. You can't do that. That is very wrong. You need to understand the microstructure of your economy. If you're a net importer, just know that everything that you will do to get dollars will actually put more pressure. This country has domestic arrears of 26 billion kwacha. And if you follow the budget speech, there is a commitment that arrears will be dismantled. Let me explain dismantling of arrears in very simple language. It means that if you did work for the government and they didn't pay you, they'll pay you, which is a good thing. But I would like to make you understand that, did you know that arrears dismantling is another driver of dollar demand? You are solving one problem on the fiscal side and you're creating another one on the monetary side. What do I mean? If you pay your suppliers kwacha, let's say you did works for me for 5 million kwacha, and I pay you, and I'm your government, hypothetically speaking, and I pay you 5 million kwacha. Chances are that I have no use for kwacha in this country, because even if you give me 5 million kwacha, I will join the queue of those that are looking for dollars in commercial banks, because you know why? My inputs are coming from outside. You see what the detriment is of being net importers. You're always at the receiving end of a hard bargain. We can move. I think I spent a little bit more time, but I wanted to emphasize. Nelly, we can move to the next slide. I think the next slide actually talks about interest rate risk. So what is interest rate risk? So I've called that graph an investment opportunity and a kwacha demand curve. You guys are taught a demand curve. You can call it the term structure of kwacha interest rates. You can call it the price of money. It's really up to you. Why do I call it an investment opportunity curve? It's because if you have parents that have just been given their pension and they don't know what to do with it, you can actually tell them if they locked up that money, they would be getting those returns. So if you locked up your money in 1 year, you get yourself 25.75%. If you locked it up in the 5 year, you get yourself 34%, which is a good thing. So I want you to look at interest rates both on a borrowing and a lending side. If you're a person if you're a Shylock and you're lending people money and interest rates are going up, you'll definitely be smiling. But if you're a person that's borrowing, it means your cost of funding becomes very high. So it depends on which side of the balance sheet you are. What is driving interest rates? One, fiscal funding needs. The government borrows money every 2 weeks in what you call a treasury bill auction, every 1 month in what you call a bond auction. The size of the treasury bill auction is 1.3 billion kwacha. So every time they dangle a carrot and say, we are looking for 1.3 billion, if you have money, you go and bid. It's like an auction. The highest bidder always gets the prize. So you've got spiraling inflation. I'm sure you're thinking, how does inflation then push interest rates up? Inflation is the general rise in prices over time due to a number of factors. And I'm talking about both demand pull and cost push inflation. So then, when your inflation rate is going up, remember inflation is that variable that reduces your disposable income. That's why you find people complaining and say, for example, you guys, when you say, no, our BC is 600, no, but inflation is high. It's because you're trying to say that your BC could be 600, but you're saying that 600 would not be able to buy the same amount of goods, of groceries, of cambis. That's what we used to call it when I was at CB. We called it cambis. So your 600 will not be able to buy enough cambis compared to what you bought, say, a year ago. Maybe a year ago you bought a trolley, but now it's half a trolley. That's inflation. It's eroding your income. So what I'm saying is it does not make sense to get into investments that are below inflation. We call those underwater investments. So if you hear me talk about, oh, this investment is underwater, or this asset price is underwater, then I'm telling you that your inflation actually eats your return, meaning your compensation is negative. It doesn't make sense. It's like you build a house and you get a mortgage and you're paying back 5,000 kwacha every month for that mortgage, but you decide to put that house on rent. Would you want to price it at above 5,000 or not? It will definitely be above 5,000. If you price it below 5,000, then you're making a loss because whatever return you're getting is actually getting swallowed up with with the return that you're getting. So that's what we're seeing. So when inflation starts to tick upwards, it's a sign that your curve could be soon correcting and the pressure for interest rates to go up becomes high. Then there are monetary policy actions. There are also drivers of interest rate risk. For example, you saw what the central bank did in February. On the 17th, they hiked interest rates by 50 basis points because all fundamentals are actually speaking towards pushing interest rates up. But then there's one small problem they have, COVID. So you can't push rates up so much to the extent that you're now thinking about businesses, how will they survive and everything. We can move to the next slide. I know I'm running out of time. So we've also got what you call your country, sovereign, and credit risk. What is country, sovereign, credit risk? It's very simple. As a country, what is your fiscal posture? We look at things like political risk factors to come up with what your country posture is. Is your country politically stable? When you're going towards elections, do you have violence? I think Zambia is a living testament of peace. We're a peaceful country. We cannot be compared to most African countries, and we are a beacon of democracy, even if there are pockets of violence here and there, but you will find yourself demonstrating. So, there's fiscal policy, debt. Is your debt escalating? What is really happening? What's happening with your expenditure? What's your fiscal deficit? All those things that those rating agencies come and gauge you for. Your Standards and Poor's, Moody's, and Fitch. Then we talk about your earnings capacity. Talking about your earnings capacity for Zambia, we'll be saying, what are your copper prices? If they're going up, are you collecting more in taxes? All those factors drive what your country, sovereign, and credit risk posture is. Then we look at your T&C. T&C stands for transfer and convertibility risks. So the question is, how easy is it to convert dollars? Right now for Zambia, it's very difficult because there are no dollars on the market. So your T&C risk is high. Then you've got capital costs, which is what your interest rate risk is, and we're just calling it with a different name this time. And then the ease of doing business. Can you do business when you don't have dollars? When there's instability in the country? When your earnings capacity is low? It becomes very difficult. So that graph I've put there is just your Euro bonds, and it's measuring what your credit default spreads are. Zambia is actually default rated by all three credit rating agencies. It's not a good thing because you know what the risk is? Sentiment has dwindled. So those people that were thinking about investing in Zambia are sitting on the fence and they are waiting for the outcome of an IMF discussion. If the IMF discussion does not go well, they're going to go to other jurisdictions. Then we lose out on foreign direct investments. But you can see how everything is interlinked from the way we were speaking. The next slide. We're almost done. I know I've talked a lot. Then we're talking about commodity price risks. And I've chosen a commodity that all of us are very conversant with. Yes, today, the price of copper is $9,100 a metric ton on the London Metal Exchange. What is driving this demand? The electric car era. One electric car by Tesla will use 20 kilograms of copper. So that's already demand for your copper right now. And I think you can actually link that with whatever is happening in the mining sector, where the state will now own Mopani and Konkola copper mines. And if the state plays its card right, then all those benefits should now start trickling to Zambia. So it's a good move, but on one condition: the mines have to be managed by professionals. They have to be done. It has to be done properly, or else we'll miss out on this electric car era. Chinese demand. The Chinese economy is growing fast. It looks like it wants to catch up from all that lost growth in COVID period. And that is then causing demand for copper to go up. There's a supply deficit in the world. And then Joe Biden also announced that he's got a 10 trillion infrastructure project. It will need copper. So you can see that all countries that are producing copper are so excited because the copper price is now shooting upwards. It's at a 10-year high. The last we ever saw copper at this level was it in 2008, somewhere there, over 10 years ago. You can imagine. So those are what your commodity price risks are. It's very important. We talk about copper, not that we just want to talk about the mines, no, but we look at the supply businesses that service the mines. So we're looking at people who clean the mines. We're looking at employment. You're looking at suppliers for gloves, for overalls, for everything. So the economy of the copper belt can just change overnight if those mining risks are then managed properly. We can move. This is the last slide, I'll promise you. That's now food security risks, which I was talking about, to say you want to make sure your agriculture is in place. Last year, 3.4 million metric tons, bumper harvest. We can clap for ourselves, but I don't want to keep clapping because this year we're projecting 4 million metric tons. I'm still sad about it. Why would I be sad about a bumper harvest? I'm sad about a bumper harvest because it's actually been, research has actually shown that Zambia has capacity to actually produce 9 million metric tons and be Africa's breadbasket. Zambia and SA put together can actually feed the entire Africa when it comes to corn, and the markets are there. But what is it that we're not doing right? You can actually see that that's an opportunity lost. Earnings capacity. Do you know that a bag of maize in the DRC is like 4 times what you would get for selling that bag of maize in Zambia? But we're not utilizing that opportunity. So I thought I should just talk about food security risks as well and speak about diversification, because now you saw what cassava did last year. For those who grew cassava in Northern Province, that cassava was being used to make hand sanitizer. There's an opportunity. Whoever thought that cassava would be so much on demand? No one. There's tea, there's coffee, so all those crops. So we need to move from this concentration risk in maize and start. That is why when surveys come out and they tell us that there's a malnutrition index, and then we start arguing. Malnutrition doesn't mean that you eat and get satisfied. It means that you're eating the same foodstuffs over and over when you have potential to eat, a variety. So let's think in those lines. But I thought I should just give you an overview of what risks, both financial and non-financial in nature, look like. But I'm limited for time. So I think at this point, I'll keep quiet and take questions. I hope that was insightful, but I'm happy to take any questions. Oh my God, sorry. The last slide. That speaks of sustainable development goals. So what the United Nations is trying to do right now is they're trying to look at sustainability and make this world sustainable. Like everything that we do must be sustainable. If we're going to have energy, it must be sustainable. So you're looking at no poverty. So if we're going to talk about no poverty, the question is, what are governments doing? X, Y, Z. Zero hunger. We're talking about quality education. It's not about access because everybody has access to education, but what about quality of education? So we want the same thing that a child in Kalingalinga and the same thing about a child who lives in Kablonga should have the same opportunities. The child in Kablonga will talk about digital learning, but what about the child in Kalingalinga? So we're talking about quality. Then there's gender and all those things, industrialization, technology as an enabler. You can read that in your own time, but that's the type of sustainability the world is getting to by 2030. But of course, we have risks getting to there. COVID disrupted. So all those programs getting to 2030 were disrupted. But the question is, we need to get back. We need to plant trees. We need to think about climate change. That's what those goals are about. I think the last slide is a thank you slide, isn't it? Thank you. I'll take questions now.
Thank you so much, Mutisunge, for that. That was really, really insightful. I think most of the indices that you based your presentation on were indices that, or are indices that we learn of in school, but you made them sound so realistic and really connected what's happening in the real world to what we learn when we are in school. So thank you so much for that. The reactions in the chat tell me people are excited, found your presentation to be mind-blowing, interesting, insightful, and so much more. So at this point, I'll hand over to our co-host, Elinase, to handle the questions.
Okay, afternoon. As Nelly said, that was very insightful and everyone enjoyed, as you can see from the chat. So one of the questions is from Jared. He says, deep cut financial crises like the 2008 financial crisis and the 2020 COVID-19 global recession are totally unforecastable and very high risk events. Is there anything that businesses, investors, and individuals can do to hedge themselves against such risks?
Thank you so much. That's a brilliant question. So yes. So what happens is when you have a financial crisis, you build what you call scenarios, okay? So you go to 2008. Apparently, there's been no financial crisis in the world that has beat what COVID has done. So 2008 looked at what the cause was, how interest rate moved. So you start to stress test. You build a scenario. So when you build that scenario, you start to run these scenarios on your book. And then you start to mimic them. So what you do is you will simulate the actual, crisis and see and to test the resilience of your portfolio fund, all that. So with COVID as well, scenarios have been built and they're still being built because I think COVID has impacted your exchange rates, it's impacted a lot of things which now businesses are running to say, what was the worst experience in COVID period? And how have we managed to survive? So when you build a scenario, it helps you in formulating and determining the amount of capital you must keep as a buffer for that. Remember, you keep capital as a buffer for risks. So if it means that you have black swan events, those are events that you can't foresee, that then is what determines the amount of capital that you need to hold. And then it also gives experiences. Sometimes it's actually, we are very lucky to be alive in these times. It's a very controversial statement, but it allows you to be able to, I'll give you an example of what we do like in the bank. We learn from each other. So you look at what Zimbabwe went through. Zimbabwe went through a very difficult time. Mozambique went through a very difficult time when it comes to debt-related issues. Those are the people that we network with and we start speaking to them and say, when you had a currency problem, how did you deal with it? How did you navigate? So this is a time to share information. This is a time to keep data. That's why I was referring to data. You need those tools which data scientists have. And this is a time you should now start getting comfortable with playing around with these data tools, because when you keep this COVID scenario in that period, you will be able to then build in scenarios that will help you then survive as a business. Maybe you were maybe COVID has actually shown you that you were undercapitalized. So now you're thinking, oh my God, I think we need to ramp up our capital and things like that. So it's an ongoing, and it's a learning, and it's new for everyone. I mean, this pandemic thing, it's totally new. No one ever thought that pandemics would bring the world to its knees. So that was it's a good question you asked. Thanks.
Okay. The other question we have is from Gerald again. He says, with regards to national debt, with its impact on sentiment and inflation, would you suggest putting up laws that probably limit how much government can borrow, or that might be a disaster for Zambia's economy?
If I tell you that that's the most genius suggestion I've heard coming from anyone this year. In fact, the US have passed a constitutional liner that says you can't spend what you don't have. And it ties you to say you can only do expansionary programs in years of a surplus. That's what we need to learn in Africa. In the US, it's there. You don't spend what you don't have. And that's brilliant coming from Gerard. That's what you need. But that voice needs to come from people like you and me. So when they say attend these sessions, don't shy away. As Unzabega, you can go and make submissions and say, as Unzabega, this is what we feel, and you argue it out. But that's what it is. But because we don't have those provisions, spending the lead is out there. Accountability, very important. So it's a brilliant suggestion. It's the most genius thing I've heard.
Okay, we have another question from Shamapumbu. He says that you had mentioned it's not being wise to have investments that are underwater. That is an investment that wouldn't be a good hedge against inflation. So his question is, would you agree that Bitcoin is the best hedge against inflation, or any other cryptocurrency for that matter?
I'll qualify my statement. At the moment, Bitcoin is number one. People are much more excited about Bitcoin than anything else. I am of a different view. The excitement that you see right now for any investor is because the returns are extremely high. Anybody would want to lock up their monies and get a return that is 4 times the following day. Remember what I said about risk? High risk, high returns, and in small font, higher falls. It's very risky right now. There are people who've lost their life savings because they locked it up in Bitcoin. I would tell you that Bitcoin is a lot of speculation. You need to be wise enough to know how much you are throwing in there. You can make it, or it can wipe out your entire earnings. I'm still of the view that gold is the safest asset, because from biblical times, there was no Bitcoin in biblical times, but you can imagine kings were keeping gold as a store, because you see, gold, you keep it, gold is not subject to inflation changes. You just put it under your bed and you'll just be waiting. And the day that everything is okay, when the price is high, you will sell it. But for Bitcoin, there's volatility. So yes, a lot of people, especially Americans and the world, believe that it's the safest hedge against inflation. That's very speculative, I must say. Yes, the returns are so attractive, but then we don't want to have you in hospital for high blood pressure because all your earnings just went. So you need to be wise. So this is where portfolio management becomes very critical. Those are risks that we're talking about, and we're talking about market risks. So good question as well.
The other question we have in the chat is from Ethel. You had mentioned something about having the ability to influence the dollar. So how are you as an association helping people with small businesses to achieve that?
I think my contribution was misunderstood. Small businesses cannot influence the exchange rate. What I said was, I broke down the drivers of dollar demand, and I think I highlighted one of them was agric inputs. And the agric input I was saying is an opportunity for whoever is thinking of setting up a business to start manufacturing fertilizer. Because then if you can manufacture fertilizer within Zambia, we will not worry about importing fertilizer. We will then simultaneously be removing pressure on dollar demand. That's what I said. So for smaller businesses, no, I didn't mean it that way. So it's the opportunity for a business. If the small business has enough capital to start manufacturing fertilizer, then well and good. They could service a portion of the market. But I think that's the context in which I had presented that.
Okay. Another question from Prince. We have plenty of land with some small-scale farmers who own and grow maize and other crops only, enough for their consumption. In most cases, they have no information on how to manage their land for higher production. So is there a way they can be informed alongside FISIP to get the best out of the project?
Well, yes. It's actually an opportunity for someone who's doing a degree program like you to actually do a paper or a thesis on that. But awareness is very key. And I do acknowledge that we all play a part in this. Someone here might have a grandmother, an uncle, an auntie that is into agriculture, and then you can pass on the message. But, and I also acknowledge that the only reason why people grow crops enough for their livelihoods, food to mouth, is obviously they struggle with inputs and they're not probably maybe getting enough fertilizer, they can't afford. But I think in the longer term, we need to create the relevant awareness and make it attractive for these people to start manufacturing on a large scale. But we can only do this if we start thinking about outgrower schemes and access to markets. For example, Zambia has not done very well when it comes to commodity trading. And when I talk about commodities, I mean like grain trading. We have not done very well. Grain trading apparently is supposed to be like a stock market where if I'm a farmer in, say, Kafulafuta, and then I start that, there's this project which is supposed to start, but I don't know how far it's gone, where I don't need to put my maize in a lorry and drive it all the way to Lusaka. All I need to do is go to Kafulafuta, find a barn, and when I take my maize to a barn, I'm given a warehouse receipt, and that warehouse receipt is like certificate of title. I can actually use that warehouse receipt to go to the bank and discount. That's discount finance. We haven't yet gotten to that level. We need to push to get it to that level. People only get motivated if they know that the return is high. Just like you asked me a question about Bitcoin, I'm sure you're motivated with Bitcoin because the price is through the roof. So what I'm trying to say is there's a lot of work that needs to be done in that area. Access to markets, that's number one. But what has happened is instead of capitalizing on real markets, we are depending on the Food Reserve Agency. And the Food Reserve Agency's job is not to give you high prices, it's food security. And when they're looking at food security, their job is just to buy enough maize that they can keep for the nation to have sufficient stock so that minimum prices don't fluctuate. But we've made it very hard for the government because now the Food Reserve Agency has turned into a de facto trading platform because the FRA is the government. So people are complaining and saying, oh, this price of maize is too low and whatnot. So you're putting pressure. Instead of the FRA focusing on buying maize for food security, they are now putting pressure on the government to start increasing maize prices, and that's adding a fiscal problem. So sorting out and creating that attractive grain trading platform is a collective effort. Policy making must be right, the private sector must kick in, and we need to come up with that exchange. Until then, we will forever be wallowing and crying over being shortchanged on maize prices. So that one, very good question, but it's a conversation we can have on another day. But I think those are the things that we need to do to make it attractive. That way, those people will start. In fact, let me deviate a little bit. So we met with the president of some agriculture organization in Africa. It's called Theo De Jager. So when Theo is from South Africa. So Theo said, why don't you guys in Zambia have land, but you don't have any land expropriation issues? So meaning you've got so much land, but you lack capital. You don't mechanize. Your small scale farmers are still using hoes, and cows. There's only a limit to which you can do agriculture with a cow and. So what they said was, why don't we have synergies where you get into partnerships with South African farmers? So the South African farmers will bring their mechanization and their capital, and then you provide land, and then we talk to chiefs because chiefs have so much land. That way, we'll be sorting out commercial farming potential. That has died a natural death. we need to follow it up. Follow up on it. So we have so many ideas, but implementation seems to be a problem. Yeah.
All right. Thank you so much for answering the question. One more was if people have more questions, what's one way that they could reach you personally? Outside of this meeting.
They can channel them through. They can channel them through Nelly, and then Nelly will get them to me, and then I'll respond to all of them.
Yeah. Okay. All right. Thank you.
Right.
Thank you so much, Elinase, for dealing with the questions. Thank you, Mutisungile, for answering each question. Thank you so much to our attendees for sparing your time to learn more about financial risks and non-financial risks. I'm sure you found this very informative. Unzabeka has many more webinars lined up for this year, so please like our page on Facebook, join our communal group. It's the link is in the chat so that you can easily access our updates. Thank you so much. This meeting has now come to an end.
Cheers. Thanks.